Another recurring topic that we're seeing pretty often this year certainly is the election. So looking below is the average return for non-election years versus election years. So the dotted red chart shows non-election years, and that dark blue line below shows average returns throughout election years. So while there is certainly a lot more volatility in those election years, they're very similar returns overall and even slightly higher. Another important thing to note is that we've had a lot of people say that they'll wait it out, they'll wait till the election's completed, and then they'll throw their money into the market. But if that's the case, you'll certainly miss those summer months where the majority of the returns have actually come through election years. Of course, past is not indicative of future returns, but if we're basing anything off history, it could provide great opportunity. And then certainly at the far left side of the chart is what we've done year to date. Through the end of March, we were up nearly 10%. As of April 22nd, we're sitting around 5 to 6%. So we still think there's good runway there. The strong returns have certainly been based off good earnings from companies. And we have two former presidents, one sitting president running for election, which isn't always normal. So we have a slightly better idea of how their policies may be next year. So taking into account all the market activity that we just discussed, some of the portfolio themes that we're taking and using are to increase value stocks versus growth stocks, because as Manny said, tech has really had a runway, but it's dialing back slightly. Another thing that we're doing is increasing equity slightly over bonds. And another is we're increasing duration. So we're taking you and putting you in slightly longer bonds just to really lock in those higher rates for longer. And lastly, we're just diversifying across emerging markets a little bit more, so a little more access to the countries out there that we believe will provide you better opportunities.